back to the Real Estate Reserve podcast. Jason Balin from Hard Money Bankers, Ian Horowitz from Equity Warehouse. Looking forward to a great show today, Ian. We've got a guest from Ohio that is concentrating or has been concentrating on multifamily investment. And, you know, I think some bigger multifamily stuff, right? He was telling us 100 plus units he likes to concentrate on. So I think that's great. I know a lot of viewers and watchers and followers are in so many different asset classes. And, you know, one of the questions I'm definitely going to ask him is, you know, where he thinks the multifamily market is going and, you know, how that's looking with rates and, you know, and, you know, tenants and if the rental rates are going up, things like that. If you're, you know, a first time viewer, watcher, thanks again for all your, you know, thanks. We're going to have a good show. And if you're a return viewer, watcher, follower, thanks again for all your support. You know, we bring in guests that are actually doing real estate transactions all over the country, not industry gurus or things like that. We're not gurus. We just like providing tons of value. And the joke is if Ian and I aren't live talking to everybody, we're just talking to each other about these exact same topics anyway. So we might as well, and, you know, stream these to the interwebs because that's so much more fun.
That's right. And if you're watching this, the reason Jason's tripping over his words is because he moved his desk to the other side of the office. So he's got a new camera angle. He's a little uncomfortable. Guys, I got to call it out. But hey, guys, if you get any value out of this, please feel free to share the show. That's the best compliment we can give our guests. Like Jason said, these are real people doing real deals. They're not gurus. They're not trying to sell you anything. They're just telling you exactly what it looks like. So that's the best thing we can do. And we don't have any sponsors, but today we will be sponsored by the energy drink. And with that said, let's bring in Lee Yoder. What's up, brother?
Hey, what's up, guys? Thanks for having me on. Love that. I love your intro video. That's a sweet video. But yeah, excited to be on, guys. Thanks for having me.
Just don't tell Ian's intern that because that'll go to his head a little too much. But we appreciate it. He did a good job with it. So Lee, tell us a little bit about, you know, where you're from, what type of real estate that you currently concentrate on.
Sure. Yeah, I live in Southwest Ohio, just north of Cincinnati, and I was a physical therapist and got into real estate, fell in love with it, and was just, you know, tried as hard as I could to get to the point where I could do it full time, and that happened at the end of 2020. So now that's all I do, and we syndicate, meaning we bring, you know, lots of investors together. I guess your guys' listeners probably know that, and we buy bigger multifamily properties, and then couple years ago, we started managing them ourselves. So we have a property management company as well. And we're up to 886 units, mostly in Ohio. I was telling you guys before, we just got into Indiana as well. And loving it. I love it. So I, you know, just trying to do more of it and, but trying to really make sure we have a good company and we operate really well before we just, you know, keep buying.
Has it always been multifamily? Was that your first deal ever? Or did you start with smaller stuff?
Yeah, started with a single family flip, 2017. Just bought a little house in the town that we live in, and my wife and I, you know, put a ton of time into it. Hired some help, but flipped a house. And then the next year we did a duplex, and then the next year we did a 16 unit, and then, you know, did a few more, and then got into syndication after that. So just kind of somewhat slow and methodical, like just a deal a year for a few years. And that third year when we got the 16 unit, we got an 8 and a 10 as well. That was in 2019. Got that portfolio stabilized, did a ton of value add to that. Then the COVID, you know, stimulus boom helped. So we sold that entire portfolio at the end of 2020, took all that equity, all that profit, put it in our savings account, and went all in.
Yeah, no, I think a lot of people went through that. And it's actually got a question that I got for you is, you know, there was the COVID economic boom. You know, we're seeing some retracting rates in the rental market. What are you feeling out there? I mean, you guys are truly middle America. That's how they classify you, at least when it comes to politics. What is Indiana? What is Ohio? What's happening? Talk to us about what happened during COVID on street rates for rentals, and what do they look like today, and what are they doing?
Yeah, I can give you a good example in just one property. We bought a 95 unit east of Cincinnati. So it's not in the outer loop of Cincinnati, but it's just outside. So, you know, we rent a little bit lower than some places in Cincinnati. I mean, we rent higher than some of the bad places in Cincinnati too, but, just think of it as Cincinnati, 95 units, 70s build. So C-class workforce housing. We had that under contract early 2022. And at that time, every month that we were working on closing that deal, our deal kept looking better because rental rates were just running like crazy, right? And they've been doing that in 2021. But man, this was truly the peak to me. Was into the spring of 2022. Of course, in March of 2022 is when the Fed started raising rates. So we also were on the end of that, where a week before closing, our lender came to us and said, "We're gonna have to raise your interest rate by 0.5%, and we want to take 180,000 of your proceeds and put in an account because we're getting a little bit worried." So that deal was right on that turn, right on the turn. I feel like right at that we had got it under contract at the peak. Closed as we were kind of already starting to head down as interest rates started affecting things. But man, rent was just screaming higher all through that summer of 2022 into the fall. We just could not find the top of rent. I mean, every time, like, just filling so fast, we're like, let's try this. Let's try this. Let's try this. When people would leave, it was like, awesome, renovate this and let's try even higher. Let's try even higher. So I think when we were underwriting, man, it's been a while ago, but I want to say we were underwriting that the 2 beds, when I put an offer of this deal and won it, that 2 beds would rent for like maybe 1,100, maybe even less than that, maybe 1,050. And by the time we're closing, it's already like getting close to 1,200. By the end of the summer, we rented a couple, and literally just a couple. It turned quickly. We rented a couple at 1,300. So just ridiculous growth right there. But I'll tell you what, today we are back to 1,100 on those 2 beds. So we're happy with that. It's fine. That property's cash flowing very well, but I'll just tell you, it's interesting to me. I'll see certain reports that show that, the Midwest and even Cincinnati in particular is one of the markets where it's like, hey, strongest rent growth in the country. But I'll tell you, we've not really seen it. And that as an example, we're still at 1,100 now. That property, if you look at our average rent, we've gone up every month. Maybe a few months ago, we kind of finally stopped going up. But because, our target rent was 1,100, but the average rent at the property, or 1,100 for 2 beds. There's a lot of 1 beds as well. But let's say the average rent for the 2 beds was probably 900 at the time that we purchased. So these past 3 years, we've steadily gone up because we don't just jack everybody's rent to 1,100. That's just the new people coming in. So we're still seeing average rent at the property go up, but that market rent is back to where it was in the spring, back to where it was 3 years ago. So I would say like market rent has not seen growth in 3 years. So that's just one example, but I think other guys I talked to, other properties that we own, we've seen similar things. So because we bought some value add, we're still pushing the average rent at the property slowly but surely. But that market rent has not really gone anywhere in 3 years. Whereas, the 3 years before that, and kind of some of my story, we bought those small multis and gosh, rent was just taking off. And so that's why we were able to sell them for so much. So man, even before the COVID stimulus boom, 18, 19, those are really good years as well. But man, to me, the peak was the spring of 2022, and we've really seen things back off. And then what I've seen at least a year now, if not 18 months, is delinquency. We see more delinquency. It's harder to keep people. You can't push as hard. So I see softening in rents, stagnating rents for sure. And then occupancy, is down. It's tough. So, I'm sure you guys have had other people on your podcast. I hear a lot of other people. This isn't, something I've just been saying, but we really focus on occupancy because we'd rather have people stay than because when they leave, it's harder to go get people, and they might come in paying a little bit less than the person we lost. So, long answer, but that's what we're seeing.
I think that's pretty consistent to the market. It's also consistent across many asset classes. I can tell you in self-storage, same thing. We're back to 2019, 2020 rates.
Yeah.
Apartment building, same thing, dude. We bought one at the start of COVID, and we went from, we were targeting 1,000 or 1,100 for 2 bedrooms, and we were getting $1,295, $1,395. And then, like you said, delinquency immediately. A little bit there after like 22, 23, and it just came back down on a steady track back to where we are today. It's interesting to see that it's consistent across the country.
Yeah.
What do you think? Before we go to what do you think the future holds, what I want to ask is, you buy something at an average of $900 rent, you're trying to get to $1,100. How much in capital improvements? Like, what's your math look like when you're looking at trying to jack these rates? Is it like, it's just underperforming, I just jack them, or you put in capital improvements? And what's your metric or return on capital that you're looking at when you're pushing in? Because I don't think a lot of people understand how you're calculating these things.
Yeah, great question. No, we put a lot of capital into them. I mean, we want to put the most capital into the units themselves, because I believe that's what residents care about the most, because that's their home, right? They don't care that building over there on my property got a new roof, right? Or even got new windows, or the landscaping looks great. They care about their building, but mostly their unit. So that's where we want to put most of it. But no, there's almost always, we want the whole property to look better. So we like doing parking lots, driveways, stuff like that, something that everybody benefits from, everybody sees. Of course, roofs, again, people don't get that excited about it, but we're going to take care of them if they need it. But we might do windows if they need it. We might do decks if they need it. But we want the landscaping to look good. So we're going to try to put money into the property early on that everybody sees and everybody benefits from, because that does help, I believe, when we go to raise rent for everybody. So no, we do not just jack everybody's rent. As an example, you and I, Ian, have both kind of thrown out some numbers. So let's say average rent is $800 and we want to get to $1,000. Well, if somebody moves out paying $800, we're going to renovate the unit. So that's where we want to put money in. We're going to make the unit look nice. And I'll say this, I don't want to get off on this tangent, but we're doing less to the units today because, maybe before we're like, man, if we make the unit really nice, we'll hit 1,050. Today we're like, let's do less. And that way, if we have to come down to 950, we're feeling better about it. So that's another little change. But hey, if somebody moves out paying $800, we're going to renovate the unit. Next person's moving in paying $1,000. If somebody wants to renew, well, they're probably going to $850. So if they renew, we don't have to do anything. They're bumping to $850. If they leave, we got to put money in the unit, but now we're bumping to $1,000, right? So $50 if they stay, $200 increase if they leave. But that person that we bumped to $850, in my experience, they're going to feel better about it, or they're going to, they're just going to feel better about it, have a better story in their head if they go, they're jacking my rent up a little bit. I mean, $50 doesn't feel good, $50 a month, $600 a year, but the owner is putting money into the property. They are making the property look nicer. I do appreciate the potholes getting filled and the parking lot looking nicer. So we come with capital and we want to spend that early because we're going to start pushing rents right away. Right. So that's kind of the strategy there. As far as a return metric, I would say, man, I'm pretty simple. It's kind of all calculated in through my underwriting spreadsheet where like we have a metric of a return we want to give our investors, and we want to hit that early on. So the more capital we raise, the more people we got to make a return to. So that's where that push and shove comes, where it's like, man, we want to put some good money in the property, but we got to pay a return on that. And we want to, hit 8% as quickly as we can. So that's kind of the return on the capital that we're looking at. And of course, the more you put in the property, the more you're raising. It's kind of how we think about it.
So you mentioned obviously turnovers and, wanting to get a premium for these, rightfully so. And also, a lot of these are obviously some sort of value add at the beginning, or you're making these look nice. And I think a lot of real estate investors, not just on the multifamily side, but on all the sides of it, they forget about kind of capital expenses and actual cash injections that they're going to need, right? It's like, I got this beautiful renovated, even if it's a single family house, I got this beautiful renovated property and I got a tenant in there. It's like, well, guess what? In like 5 years from now, when that tenant moves out, like there's real expenses that you have to put into that. Do you guys have a rule of thumb for like reserves, like percentage wise that you kind of scrape off that's going to get re-injected into either turnovers or capital expenditures? I don't know if that's one account, two accounts. Like, I think that you give a lot of good insight to a lot of listeners because folks don't realize that, right? Like when we owned, about 24 rental properties, by the time we bought them and sold them, I renovated them at least twice, sometimes more. Yeah. And, I think that it's kind of like, oh, cool, I'm going to get, $200 per unit on this multifamily property, and it all goes to me and nothing else. And they forget.
Oh man. Yep. No, that's so well said. I mean, we try to bring enough capital to do the majority of the units. We want to have that up front because you're absolutely right. If you don't, I mean, there's a couple different line items in our operating expenses. One is just called turnover. But to your point, Jason, like that's not a unit renovation. That's just somebody moving out that took pretty good care of the unit, maybe lived in it in a year or two. And we're only spending we're still spending like $1,000, maybe even $1,500. But that's what that turnover line item is. That's not, like you said, the person that's been living there 5 years, the person that's been living there 10 years. That's going to cost $10,000 at least, right? So that turnover line item, and I think this is your point, Jason, like, people might have a little bit of that in their mind, but I'm telling you, that turnover line item is not going to cover people that move out and you really have to renovate the unit or the house, which is much different. So we've got that turnover line item, but that's just people that move out and just needs a freshen up. Maybe carpets need redone, maybe toilet needs replaced, things like that, $1,000, $1,500. We do scrape reserves, and that's just to increase our reserve account and that reserve account. So that's something like $250 a unit per year just to be putting more back in. But you're absolutely right, man. And I'll be honest with you. That's something I've learned. We don't come in with the capital to do all the units. And man, when that capital comes out or runs out, even if you've done, we own several 96 unit properties. And let's say we've done 60 and we brought the capital to do 60. Man, those other 36 that we have to do, when they come back up, to your point, Jason, like that hurts. I mean, that really hurts your cash flow because, again, that turnover budget does not cover a $10,000 unit renovation. So we've fortunately had some capital. I will tell you, one strategy for that is if you're going to do 60 of the 96 over like a 5-year period, it might work out real well that you hit your refinance and you do a cash out refinance, but you need to plan like, hey, a lot of that cash out from that refinance, that's going back in. And now we're doing the other 36 with that. So we kind of have a plan for some of that, but I'll be honest with you, that's kind of a strategy I've developed as we've gone that I'm like, man, yeah, I thought kind of we'd just be able to pay for these other 36 out of cash flow. And it doesn't work like that. That hurts every time one comes up now on some of these properties that are stabilized. Again, they're cash flowing really well, but boom, you get that one big unit renovation for somebody that was living there 10, 15 years, and it crushes you if you don't have that capital set aside. So you're either pulling a lot out to prepare for, or you're bringing it up front, or a cash out refinance to do it. So maybe I'm not providing all that much value, but I am seconding what you said, Jason.
Yep.
That's something you really have to prepare for one way or another.
This is the ton of value because this is the real shit that nobody wants to talk about, right? Like, and we try telling people like, yo, those guys that are telling you they're doing X, Y, and Z, it's all a lie. Like, nah, dude, like they said I'm like, I know, but we live this shit every day. I'll be honest with you. I did the same thing on a 76 unit building we bought, cashed out, distributed all the cash to the capital investors, and then we said, fuck, because rates started retracting, cash flow. So here we are, just like we haven't made a distribution, but we're still improving the property because in the end there is this equity pop. And I think you bring up a good point, is like deal cycle. Like I finally just sold one of our 44 unit apartment buildings and we made a bunch of cash, and we made 10 years of cash flow in one fell swoop, even though we were making $30,000 a year for the partners without even thinking about it. And we made 10 years of cash flow in one shot. And it's like, damn, dude, like that's crazy. So like, and I've always been the refinance and hold everything and just collect it all, but there's this return on equity. What's your thought process on refinancing, selling off properties, getting to the next level, recycling capital? What does that look like for you?
Yeah. I mean, short answer is I like both, Ian. I think I believe, I mean, man, if you study really wealthy people, I do think it's true. They just don't sell. Like they just hold, they refinance, they just keep borrowing from the property, and they don't pay taxes. I believe in that. So ultimately, I want to get some properties that we never sell, that we just keep milking them, right? And I think when you can refinance and get all of your investors' capital back and then hold that property, I mean, there's nothing better than that. Like that's the golden goose. That's like winning, having your cake and eating it too, I guess. But at the same time, you don't get to harvest all of your equity when you refinance. And I also believe in the velocity of money. I do believe if you took two guys and one guy was just refinancing, never selling, in a 10-year period, I do believe the guy that's selling and turning, I do believe he's going to be ahead. his net worth, his money, his investors, like their return, they're going to be ahead. But it is a lot more work, and it's really tough to find deals. So that guy will be ahead on paper. I guess I'd say that in theory, that guy's going to be ahead, turning his money. He's going to make a better return. But in practice, like you guys are talking, like when it's real on the street, just because you sell and you got cash doesn't mean you can go find another great property. And so sometimes it doesn't actually work out that way. And that's where, like, man, if you've got a great property, a lot of people say, man, hang on to that. Jason, you went like Halloween on us there for a second, like a eerie.
Dude, I realized this new location of my desk. Like before, I was right by the light sensor, so knew I was here. I could go like this, and it would turn right back on. And I didn't realize. I'm like, oh shit, it's all the way over on the other side. Yep. Yeah. Anyway, it's tough to find good deals. I'll tell you one thing that always pops up in my mind is whenever I'm buying something, I always look at the guy selling it. And it's not always the case. I bought from people that have just owned for a few years and flipped or whatever. But when I buy from a guy that's owned for 20 years, every time I'm like, man, I wish I was that guy. Like, I wish I was him with this property and I would just refinance and hold on to this thing. And so I keep trying to remind myself of that. So like, okay, Lee, if you want to be that guy, like, you can't sell. Because really up to this point, we've sold everything. The longest we've owned something is a little over 3 years. And I haven't been in the game that long. But that's kind of a long answer. I do think, Ian, the way when you said 10 years of cash flow, I've made that calculation as well, where I've said, and that's where sometimes I think I was just talking to a guy the other day and he was thinking about, and this was just with a single family home or maybe it was a condo, but he's like, man, I don't know if I should sell, if I should refinance. And I was like, well, what's a number that would make you feel like, dang, that was a good decision to sell that? I'm like, throw that number out, and so I sometimes I think it's just a numbers game. Like, man, if we could make 10 years of cash flow, wow, what could we do over the next 10 years with that equity today? Right. To me, it's like, it's hard to not be ahead. So sometimes, and I'll tell you guys, there was a property we almost sold and we were going to do a 1031 from one syndication to the next. And we just couldn't get a number that was good. And so kind of the market decided for us. But we had a number that was like, we'll feel really good about selling if we sell for that number. Anything below, we'll feel really good about holding. So sometimes you let the market help you decide too. Yeah, I mean, I think it depends on the asset, the situation, if you're in growth mode or kind of legacy mode. I mean, let's be honest. And, I've been involved in some deals with Ian where in essence, it was such a good value add early on where it's like, I'm just going to use whatever generic numbers, but you bought it for $1 million. It went up to 2 million and it's like, okay, you double, you make $1 million that you can put other stuff with. And at the end of the day, like, it's not going to go to 3 million or 4 million in the next several years. Like it did. It could take a decade or longer. Like you've already squeezed out everything. So why not take that $1 million and then, have another value add that you can do or leverage that. So I really do agree that it is based on the situation. But I don't know. And also I think differently as a lender and a short-term investor than all longer-term real estate investors on. I mean, I understand their view. I just think differently because I'm always returning money. But I also look at it as like, okay, let's just say you have an $8 million lien against the building and you have 10 million, let's say you have $2 million in equity, right? Or whatever. And it's spitting out to your capital investors and yourself like a 3% return. Right. Yeah, you got some depreciation, you got some tax benefits, things like that. It's like, well, if you can find a better investment to take that $2 million to spit out a higher rate of return, like, isn't that the answer? Or is it just, because it's just an illiquid asset that's just sitting there.
Lee, let me tell you, if Jason invests in any of your deals, he will always be in your ear. Sell. But
after the value ad's over.
Well, I know. Look, we've done a lot of deals where we've refinanced, and Jason's gotten all his money back and some capital investors that he's put in the deals, and there's been great returns for everybody. But guess what? Now we're sitting on assets that we're like, all right, we're still improving, not making cash flow distributions. Like, well, we're just owning, and not everybody can use the tax benefits. So then he's always whispering, sell.
Yeah.
And after a little bit, I'm like, I get it, but like Jason said, he's a lender. He sees it all the time, and he recycles his capital more than we do. And I think that's where that rub is. Me and you put so much hard work into these properties, and it's like, fuck you. I'm enjoying the cash flow. I want to see these things go to its fullest potential. And Jason's like, well, I already turned like money over 4 times this year.
Yeah.
And I did all these hard money loans. I'm like, shit, you're right.
Yeah,
So,
but if you are getting the right amount of cash flow, it makes sense to me.
Right.
I'm not stating that. I'm just saying that like it's a position where you've already leveraged it. You've already got all your cash back, and that's great. That's like you said, have your cake and eat it too. That is a beautiful thing. But what happens for the next 10 years? Yeah, you got all your money back. But what is it for the next 10 years? All you're doing is managing that, collecting rent, putting that into reserves for capital improvements, and you're not making any more money on it. What's the point?
Yeah. Yeah. So, I think to your example, Jay, I think it'd be tough. And I mean, I'd have to do some numbers. We'd have to drill down a little bit. But I think if there's that much equity, I would think you're making a better return than that, because if you're not, no one's going to pay that price to give you that much equity. You know what I mean?
Right.
Like if the property's worth that much, you should be making more equity than that. If you're not making more equity than that, or you're not making a better return than that, why would somebody pay you that number to give you that much equity? Because if you're not making a return, how are they going to make a return? Which I mean, we've all said that a lot, and people still pay those prices. But
it's also it's also depending on where you're at. And if you're early on and you're a growth investor and you need that velocity of capital to grow, there's no better way to do it. I mean, it's very challenging. I mean, think about all the very successful people that that own tons and tons of real estate, or they own big businesses and things like that. They've had some sort of major liquidity event or multiple liquidity event over and over and over to do so. Because let's be honest, nobody's getting rich, making $1,000 a month in positive cash flow. It takes forever to do that. Like if you're making, and if you can, like Ian started with, if you can 10x that, right, overnight, cool, let's 10x it, and then move on to the next thing. The other side, because I know some pretty high net worth individuals that I'm always like, why don't you have more? Why didn't you take a mortgage out on your property when the rates were 2%? And they're like, because I have enough cash that I don't have investment vehicles for all that stuff. So why pay the bank 2.5%, even though all of us are like, no brainer. Like I'm never paying this thing off type of thing.
Right.
But to them, they don't have constant deal flow. They're not active investors. They're very cash heavy. So to them, they want to get into an investment where it'll just stay forever, right? Even if the return's lower, because they rather deploy their cash into that sort of thing. So it certainly is situational. It's just good to kind of see where people's opinions are.
Yeah. Yeah. And another thing that comes into it, and Jason, just thinking like your business is to move capital, and Ian and I's business is different than that. And one thing, now that we're managing our own properties, that's one thing that sucks about selling, is like that hurts my economies of scale. And like I might have two properties together and it's easy to manage them. If I sell one of them, well, shoot, now what? So that's a different problem we have now too, where like our business is better as our portfolio gets bigger. And that's building that company, and we're better at managing. And so when you sell them, I mean, there's still benefits. You got that money and you can, do things with it. So there, I
already know Jason's rebut, because we've been down this road many mornings talking on the phone. He's like, I guarantee his rebut is this: we'll sell them, you'll make enough money, and your key employees, you'll give them a pay and say, look, I need 60, 90 days. You want to find another job, do your thing. But if not, I'm still going to pay you for the next however many months, and I'm going to find another deal. Thank you for allowing us to perform so well. Did I take a word for word out of your mouth, Jay?
Well, I was going to say that, property management business is a shitty business. And why do you want to do that? No, I get it. There's no right or wrong. Obviously, it's just different. It's just different. And it's
nice to be able to do both. It's nice to be able to do both. I mean, the guys, some guys that I look up to that own, 10,000 units, and I'm like, man, that's where I want to be. Man, when 2021 and 2022 came around, and they were able to capitalize on a generation opportunity to sell, but still have a portfolio. And then, it's like, that's when you're winning, when you can do both, when you can say, man, now's just an incredible time to sell. We've got to sell, but you can maintain a portfolio, but then you build it back up. It's like,
being open-minded is the important part, because too many people are so closed-minded and stubborn about it. Be like, oh, I'm never going to sell this thing. And it's like, whatever. And I mean, when we sold a bunch of our rentals, we sold them around COVID, and who would have known that, a lot of single family houses would double. Right. But like, I got out of what, we got out of them based on numbers that we were good with, we were comfortable with. And I was able to deploy it in other stuff. We're also all active investors, right? So we're always sniffing out opportunities. Which kind of leads me to, my next point. Have you guys been, like, are you aggressively looking to buy stuff if you get your hands on stuff at the right numbers currently? That's kind of, it's a two-part question.
Yeah.
There's that. And on the other side, on your current portfolio, have you formally been more conservative on stuff, knowing that there's uncertainty, right? Like I don't know if you have long-term debt on all your stuff, and if you don't, like if those rates are probably going to be higher than your shorter-term debt. Are you trying to, you don't know where the tenant, rent rates are going to be. Like, have you kind of like, is it triggered you to be a little bit more conservative on that side? I guess that's my question.
Yeah. So the first question, we're aggressively buying for, I think the way you said, Jason, was like, when the numbers work, but the numbers almost never work. I mean, I spend almost no time looking at deals sent to me by the brokerages that you guys have heard of. The only way we've bought stuff is the small brokers that pick up the scraps. And we've gone more tertiary. That's kind of, I guess, been my strategy is I buy stuff in towns that people in Ohio haven't heard of, even though they're in Ohio, because, they're just smaller towns. And they might just be an hour outside of, Cincinnati or Columbus, but that's an hour, so a lot of the bigger buyers, they're not buying that. So that's where we've been able to make the numbers work because I'm just a stickler for having cash flow. And not just relying on appreciation. And when I look at deals in Cincinnati, Columbus for sure, even Dayton, I just don't see it. I don't see cash flow, good cash flow in the first couple of years. And to me, that's dangerous. My investors aren't that interested in that. You're competing with other investment opportunities where they can get cash flow early on. So we're having so much trouble making the numbers work. We did two deals in 2023, and those were both with seller financing. Last year, we only did one deal, and again, it was an hour outside of Columbus, kind of in a tertiary market, 120 units. Got it from kind of a broker kind of before it hit the market, and we're able to get that. And then the one we just closed a couple weeks ago is 415 units, but it's 22 properties spread out over Northeast Indiana and Northwest Ohio. Very rural. Very rural. I mean, not many people would take on that big of a portfolio, that rural, and we did it, and the cash flow is awesome, and I love the numbers. So that was the most aggressive I've ever been. I've never raised near that much money. We've never done anything like that before. It doubled our portfolio almost, and I was as aggressive as I've ever been because the numbers were amazing, and it's been so long since I've seen amazing numbers. So we'll be aggressive, but again, anything that's marketed to me, I honestly don't even care to call the broker because I feel like I already know. That's maybe not a good stance, but it's so hard. On the stuff that we own, we're fortunate. I will say, that I never thought bridge debt was a great idea or adjustable rate, but more than that, we were just getting good enough debt without doing that. And I had a mortgage broker one time, kind of steer me away from that. And I appreciate that he did. So right now, everything's fixed for us. We don't have any loan terms coming due. The closest one is 2 years from now. So we could sit on everything for 2 years. Our worst interest rate is 5% right now, other than the two that we just did. And those, we have 5-year terms on 7 on the 415 unit. But some flexibility to get out in a couple of years because I do think rates are going to come down in the next I actually think they're going to come down the next year. I'm more aggressive on that, but that's because I think we're in a recession. We don't know it yet. But we're definitely being conservative. I already kind of mentioned, we're not pushing so hard on rent. We'd rather, when someone leaves, we're going to do less to the unit to prepare ourselves to rent it for less and feel okay about that because we didn't make the unit look so nice. So we're definitely being conservative. And that's another part of why it's hard to find good deals because I'm not telling myself this growth story anymore. So when I underwrite, and the broker's like, man, here's what you can do if you make all the units look nice. I'm not really buying that right now. I don't buy that for the next probably 1 to 2 years at least. So that makes it hard to be aggressive and win a deal when you're underwriting like that.
Interesting. Yeah, I think I'll be interested to see your opinion on debt. I have a little opposite opinion, but I do think the markets, while they might not come down, I do think that Q3 of this year is going to be wildfire. I don't know.
With the stress coming?
Not distressed. I think it's more that just capital is going to come off the sidelines. A lot of it has to revolve around the ability to be stable in the market. And stability could be, so what if the rates are 6.5%? We know they're 6.5% for the foreseeable future. We understand, I don't give a shit who's in office, and you can guess who I voted for. but we're not going to make this about politics. But if Uncle Donald is in office, and well, some people think he might be the answer, which so be it. It doesn't mean all of his policies are great for the nation, right? And you also got opposing forces trying to tackle him all the time, right? Like, what did they just come out the other day and say? We're in a recession and the markets are going to fall and all these trade tariffs. And if there are these trade tariffs and if there are all these things and things do get more expensive, but he abolishes taxes, well, then there's more free cash flow to the American citizen. And that improves all three of our businesses, even though it might be $1 million for a single family house. So what? Yeah. So be it, but nobody's paying taxes, right? So I think the markets as a whole, not the everyday consumer that we deal with as renters, they feel it in their cash in their pocket, but the sophisticated capital who buys our properties or, buys Jason's book of business is going to be more advantageous to get off the sidelines in Q3 once we have 2 quarters of, all right, we know what Uncle Donald's going to do. My man says he's doing everything he said he's going to do. Great. Or, hey, here's the curveball. We weren't expecting that, but we know the debt rate's still 6.5%. I can forecast off that because it goes back to your point earlier. He who can hold the longest or be around the longest, you're eventually going to make money. That's why Warren Buffett, is he the greatest investor of all time? Or has he been in the markets longer than we've all been alive combined on this channel, right? You know what I mean? So it's like, that's really, I'm interested to see, but I do think Q3 sideline money comes off. People are excited. And then you got the stability from there to midterms, assuming they don't try to create World War III and God knows what else. But I think from Q3 to midterms, about 3 months before midterms is our window. Month 6 to 18 is the window to perform. And I think people know that. So I'll be interested to see what happens. Yeah.
That's interesting. The thing about stability, and I think that's spot on. I actually heard somebody the other day and I was like, man, that's a really good point. They said, even, rates have come down a decent amount in the last month. Right. And if they were to kind of keep going down, somebody made the point. They're like, that again, that's instability. And that actually could hurt because people think, well, shoot, the 10-year, ran up to 4.8. Now we're back down, the 4.2s. That's awesome. But they said, you know what, though? Now sellers are going, well, wait a second. Yeah, I can sell more today than I could when rates are at 4.8 because my buyer can get better rates. But wait a second, rates are going down. Maybe I should wait. Maybe they'll go down further. So it's almost like if they're more stable, everybody gets on the same page that like, look, here's where rates are, the 10 years here, commercial lending is at 7%, whatever. Like that's what it is. Buyers and sellers get on the same page. But the second it starts moving around, people go, well, wait a second. Now I can pay more. Now I can pay less. Well, what if it keeps going? Maybe I should wait. And so, yeah, it's interesting that the more it's volatile and man, it sure has been. That's what's made it so tough. And it hasn't stopped yet.
Yeah, no, I would agree with that. And I mean, I think this is another conversation for another in-depth. It's probably worth having a panel of people on here because none of us know in the end, right? Yeah, right. And we're all making the best guesses and doing the best deals that are presented to us at the time and that we're looking to buy them. So with all that being said, man, this has been a great conversation. Lee, one thing we like to ask all our guests before we let them go is what is one book or podcast that you think everybody should know about or you're currently reading or you found of interest?
Man, great. I mean, Rich Dad, Poor Dad started me down this journey of realize, like a lot of people like, man, there's this whole different game that other people are playing. There's been a lot of books since then. I'm reading one now. I'm trying to build up my business a little bit. And there's a book called Who Not How. That's an awesome book to start going down the right. And I think my next hire might be an executive assistant. And there's a book called Buy Back Your Time. And so I'm in that one right now. So I'll talk about that one. The podcast, there's this guy. He's like too smart for me. I don't understand most of what he's saying, but I listen to it anyway. It's called Euro Dollar University. His name's Jeff Snyder. And he talks about rates and he's like, he's probably too smart for his own good. And like I said, too smart for me, but man, and then JP Conklin has an podcast called the Rate Guy Podcast. Just if you're following rates, and I don't know, I probably listen to it too much because then I think I know what's going to happen and it never does. So I don't know if that's good advice or not, but those are two podcasts I like.
Hey, we haven't heard them on the show before, and the Who Not How and Buy Back Your Time. Jason and I read them almost back to back, and then
cool.
I had Dan Martell speak at our mastermind, and it's just
he's awesome.
In theory, a lot of it makes sense. Executing on it is still tough for all of us as business owners. Like, fuck it, I could just do it myself.
Yep.
I'm literally doing it right now, recreating some signage for some of my properties. And I'm right before we got on, I'm like, why am I doing this? Like, just give it to my creative guy, but I'm so goddamn cheap. I can't help myself sometimes. But
come on, man, it's a $15 an hour task.
Yeah, and not even if you got guys overseas, right?
That's right.
You're paying them $100 to do it, but. Lee, dude, this conversation's been awesome. Where can people find you on the internet? They want to learn more about what you're doing. They want to check out any deals that you're raising capital for or see what you got going on.
Sure. Yeah, I'm most active on LinkedIn. That's really the only social media that I really like. That I spend a lot of time on. So you can look up Lee Yoder on LinkedIn. Then jump on our website. It's threefoldrei.com. So that's the number 3 spelled out, fold like fold a piece of paper, then REI is in realestateinvesting.com. And we got a bunch of stuff there. So you should check that out.
Right on. We'll get all that in the show notes. We'll go check that out. And guys, Lee, appreciate you. You gave us a ton of value. If you got any value out of this, Lee's just a real dude, as you guys can see. Feel free to share the show, and we'll catch you guys on the next one.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.